If you really want to know how the American economy is doing, don't listen to the guy in the gilded Oval Office. Listen to the middle-class parents standing in the cereal aisle, putting things back. For the last year, Donald Trump has gone on television insisting prices are way down, that there is virtually no inflation, that he is bringing those high prices down very fast. Meanwhile, pollsters are finding that 3/4 of Americans say their monthly costs are up at least $100. And Yale economists say Trump's tariffs alone are adding about $300 a year to the average family's bills. The gap between the speech and the shopping cart is the story. The cost-of living crisis that started under post-COVID Biden never really ended. It mutated. Under Trump's second term, the worst pain has shifted from the very bottom to the very people he promised to champion, middle-income households who thought of themselves as safe. The poor are still being crushed by food, rent, and utilities, but now the middle class is getting squeezed from two sides at once. Their grocery bill has crept up month after month. Their health insurance premiums and deductibles keep rising. And the dream that once defined middle class, owning a home, not just renting one, is sliding slowly out of reach. Start with housing, because that's where the numbers are brutal. In early 2020, before the pandemic madness, the average monthly payment on a single-family home mortgage in the U.S. was about $984. Today, it's roughly $289, more than double. The average 30-year fixed mortgage rate blew past 7% at the start of 2025 and is still stuck around the mid to 6s, a level the country hasn't seen since 2006. That might be survivable if houses were cheap. They aren't. A COVID-era price boom, layered with higher rates, means buyers now have to borrow far larger sums at much higher interest to get anything remotely comparable to what their parents bought. As a result, the entire housing ladder is seizing up. The typical age of a first-time buyer has risen to about 40, up from 30 in 2010, according to the National Association of Realtors. Younger families are locked in the rental market, watching rents climb while they chase a moving down payment target. People who already own homes are trapped for the opposite reason. Thanks to the uniquely American 30-year fixed system, millions locked in at 3% or lower during the cheap money years. If they move now, they don't just pay more for the new house, they lose their cheap mortgage and step into a much higher rate. For many, the math simply doesn't work. Redfin's data captures what that feeling looks like in statistics in the first 9 months of this year. Only about 28 out of every one. Zero homes in America changed hands, the lowest turnover since at least the early 1990s. National homeownership has actually dipped for the first time since 2016, falling by about 0.1 percentage point to 86.2 million owner households. That might sound small, but after nearly a decade of steady increases, it's a turning point. The number of renters, meanwhile, surged 2.6% year-on-year in the second quarter, one of the fastest jumps of the last decade. People are getting married later, having kids later, and buying homes later. If at all, Trump knows this is a political problem. Polls show housing costs are now the second biggest affordability concern after groceries, cited by about 38% of Americans as the hardest bill to afford. More than utilities, debt, or child care. Republican pollsters Frank Luntz and Brent Buchanan say they're hearing the same thing in focus groups. Middle-class families are furious, and they're running out of patience with both parties. It can no longer solely be blamed on Joe Biden, Buchanan warns. Voters put the Republicans in charge, and they want the Republicans to commiserate with them on the issue and start showing that they're doing something. Instead, they see a president on television insisting the water isn't rising while their shoes are already soaked. Trump's answer has been to reach for the same tools he uses everywhere: crackdowns, tariffs, and gimmicks. In his latest national address, he promised some of the most aggressive housing reform plans in American history, including a new Federal Reserve chair who believes in lower interest rates by a lot. A crackdown on immigration, he claims, will free up homes. And even the idea of 50-50 mortgages. Each of those ideas has a catch. The Fed is technically independent. Mortgage rates are driven by 10-year Treasury yields, not the president's tweets. If investors think Trump is interfering with the Fed, they will demand higher yields to compensate for inflation risk, which can actually push mortgage rates up, not down. The immigration pitch is just as flimsy. Yes, if you deport enough people, you reduce rental demand. But the ownership market is driven by credit, income, and supply, not just who's renting an apartment this year. Worse, Trump's broad dragnet and rule changes are hammering industries that depend on immigrant labor, including construction, where roughly a third of workers are foreign-born. Combine that with his sweeping tariffs on imported lumber, steel, and other building materials, and you're attacking both the supply of housing and the cost of building it at the same time. J.P. Morgan estimates the U.S. now has a housing shortfall of about 2.8 million units. You don't close that gap by firing roofers and taxing drywall. Then there's the 50-year mortgage. On paper, stretching loans from 30 to 50 years lowers monthly payments. For a median-priced home around $415, $0 at 10% down payment and an interest rate near 6.2%. A 30-year fix might cost roughly $288 a month. A 50-year could drop that toward about $222. That sounds like relief until you do the lifetime math. Analysts at the Associated Press and UBS calculate that a 50-year borrower would pay roughly an extra $389, $0 in interest compared with a 30-year loan, and take roughly 3 times as long to build $0 of equity. As one housing expert put it, a 50-year mortgage risks turning people into renters with a mortgage, paying the bank for decades without ever really owning much of the house. Economists also warn that if everyone suddenly gets lower monthly payments, their buying power goes up, which just bids up home prices unless you massively increase supply. The American Enterprise Institute estimates a 50-year mortgage might juice buying power by about 8% initially, but that edge would quickly vanish as prices rise to absorb it. Without more houses, demand-side tricks are just gasoline on the fire. Jim Parrott, a former Obama White House housing advisor, calls the underlying problem what it is, a chronic shortage of homes, especially in the middle and entry-level segments of the market. Builders say land, labor, and materials have become so expensive that the profit margins on modestly priced houses aren't attractive, so they build luxury units instead. Trump did sign an executive order in February telling agencies to find ways to cut regulation to reduce housing costs and boost supply. Treasury Secretary Scott Bessent has floated the idea of a national housing emergency as soon as this fall with proposals to streamline zoning codes, standardize local rules, and maybe exempt some building materials from tariffs. But even the friendliest analysts say that serious zoning reform would take 5 to 10 years to produce visible results in the building pipeline. People who are 35 and shut out of the market now don't want to hear about a starter home they might maybe afford at 45. They hear promises and feel time slipping away. While all of this is happening in housing, everyday expenses haven't stopped climbing. Guardian reporting shows that prices in 5 of the 6 main grocery categories tracked by the Consumer Price Index rose between January and September. Meats, poultry, and fish up about 4.5%. Non-alcoholic drinks up 2.8%. Fruits and vegetables up about 1.3%. The Yale Budget Lab estimates Trump's tariffs alone will drive an average 1.7% increase in consumer prices this year, costing households around $1,900 to $300 in lost income. Because tariffs function like a sales tax on imports, they hit lower-income households harder as a share of income. A Guardian-Harris poll from October found that about 75% of Americans say their regular monthly costs are up at least $100 compared with the year earlier, and the majority believe the economy is in recession, even though official inflation has drifted under 3%. The Yale Budget Lab and Washington Monthly call this "Make America Less Affordable." Wages have barely moved in real terms since 2019. Around $0 median household income in 2019 versus roughly $700 in 2024 after inflation. Housing and electricity rose faster than the headline CPI. Trump's tariffs, sold as punishment for foreign governments, have become a stealth tax on his own voter shopping carts. The strain is now showing up in places the bond market watches closely: credit cards and auto loans. New York Fed data show that the share of credit card balances more than 90 days delinquent has hit about 12.4%, the highest level since 2011. Total credit card debt has jumped around 76% since 2011 to roughly $1.23 trillion. A record. Citi's chief U.S. economist, Andrew Hollenhorst, warns that such high delinquency rates signal a large share of consumers are struggling, especially because credit card interest is the most expensive debt on the balance sheet. When people are missing card payments, they're not over-leveraged on luxury handbags. They're short on groceries, gas, and rent. Add in the labor market, and the picture gets darker. Jobs growth has stalled. The unemployment rate has crept up to about 4.4% from 4.1% a year ago. Fed Governor Christopher Waller has publicly warned about rising stress among lower-income households on mortgages and car loans, and says these problems will get more acute if the job market weakens further. Consumer sentiment, as measured by the University of Michigan, has dropped sharply with personal finance sentiment at its lowest since 2009. That is the backdrop for Trump's speeches about no inflation and way down prices. The disconnect is not subtle. Politically, this is dynamite sitting under the 2026 midterms. In 2024, voters punished Biden for letting post-pandemic inflation run and back Trump on the promise that he would make America affordable starting on day one. Less than 2 years later, polls show that 72% of Americans think the economy is in poor condition, and roughly 61% believe Trump's policies are making things worse, not better. Many now see the 2024 election as a referendum on Biden's economy. 2026 is shaping up as a referendum on Trump's. As strategist Tariffs puts it, the midterm ads write themselves. A president who promised to lift up the working class, now standing in a gold-trimmed ballroom while military families wait at food banks. The danger for Trump isn't just that people are unhappy. It's that the people he cannot afford to lose, middle-class homeowners, aspiring homeowners, suburban families, are starting to feel locked out of what they were raised to expect. As housing advisor Jim Parrott says, people feel they're being locked out of something that they grew up thinking they were aspiring to. In politics, taking away a dream is more dangerous than never offering it at all. The longer the affordability squeeze drags on, the more voters will ask a simple question. If this is what America First looks like in their bank account, how many more years can they afford it?